Thank you for sticking around for the launch of the Mid-Year World Economic Situation and Prospects report. I'm Martina Donlan with the Global Communications Department here at the UN, and we have two distinguished speakers from the Department of Economic and Social Affairs, Mr. Shantanu Mukherjee, the Director of the Economic Analysis and Policy Division, and Ingo Pitterle, Senior Economist at the Global Economic Monitoring Branch. So I'll hand right over to Mr. Mukherjee to give us an overview, and then Mr. Pitterle will have some more specific data to show on some slides. So please.
Thank you, Martina. I'd like to present a few headline facts from our mid-year update to the World Economic Situation and Prospects report that had come out in January. And I'd like to speak about three big picture issues: the global situation, tariffs and economic uncertainty, state of public finance across the world, and then take just a moment to look ahead a little bit. To the extent that's possible these days, there's so much uncertainty in the air. But first, on the global picture. It's been a nervous time for the global economy. In January this year, we were expecting 2 years of stable, if subpar growth. And since then, prospects have diminished, accompanied by significant volatility across various dimensions. So now we are forecasting global economic growth at 2.4% for 2025 and 2.5% for 2026. This is a downward revision of 0.4 percentage points each year, back from what we were expecting in January. Now, this is not a recession, but the slowing down is affecting most countries and regions. Among the most severely hit are the least developed countries, whose growth prospects for 2025 have fallen from 4.6 to 4.1, which is a drop by a full half percentage point in just a few months. Now, that translates into a loss of billions in economic output for the most disadvantaged of countries. LDCs are home to over half the global population living in extreme poverty, and the only country grouping to actually have a growth target of their own in the 2030 agenda, and they have been battling exceptionally adverse circumstances for a while. With this most recent shock, their 5-year cumulative growth since 2021 is expected to be over 1/4 smaller than it would have been had they just grown at the rate they were averaging before the pandemic. Now, these growth prospects are compounding the challenges they already face, such as falling ODA, limited fiscal space, and high levels of debt. And many developing countries are also still grappling with high levels of inflation, even though this is gradually moderating in some countries. The second point I'd like to make is about extreme economic uncertainty. I'm not going to talk too much about what we've all seen play out in real time, about the rapid developments with US tariffs since February this year. At this point, the average effective tariff rates for the US are around 14%, which is about 6 times higher than they were at the start of the year. And trade policy uncertainty is a factor in itself. It remains elevated, having surged to its highest value in the last 10 years, multiple times higher than the previous peak. With merchandise trade representing just over a fifth of world output, and US and China together accounting for about a quarter of total imports, it's no surprise that these changes reverberate across the world. And going beyond just tariffs, volatility and some rather unexpected co-movements have happened in a range of economic and financial indicators. Indicators may seem a little bit abstract, but there are consequences for real people and businesses. Tariffs put upward pressure on prices, and the broad-based uncertainty slows down both lending and spending. The uncertainty makes it even more likely that investment growth across the world, which was already slowing from 3.5% in 23 to 2.8% in 24, will continue to fall. And just to relate it to something we're all familiar with, for small and medium enterprises, for example, difficulty in accessing capital when most needed can be fatal, with long-term impacts for those whose livelihoods depend on them. Often, these are women. Third, a quick look at the state of public finance, which is evolving somewhat rapidly. Across the world, fiscal deficits are now increasing for a variety of reasons. Developed countries and other major economies can finance these deficits quite affordably, but for many developing countries, the fiscal situation is becoming increasingly challenging. In 2025, we expect that developing countries' median interest payments as a share of public revenue will continue to rise, reaching 4 percentage points higher than in the 5 years before the pandemic. Debt challenges could readily worsen in a year when developing countries face a double whammy of slower growth and diminished rate. Finally, looking ahead, despite all of this downgrades, are there reasons for some positivity? The answer is yes, actually, although, there is uncertainty and opinions differ. So the first point I'd like to place here is that our forecast from the beginning of the year indicated that overall the global economy was reasonably healthy. And we recognize also that when assessed in comparison to other recent shocks, such as the global financial crisis, we have a downgrade, but it's not as extreme. In the forecast that we will present in greater detail today, we are expecting that bilateral negotiations will lead to lower tariff levels, although these will not return to pre-February levels. However, despite this, an early and complete resolution of uncertainties would help individuals and businesses move forward with economic decision-making, with positive results in 25 and even bigger impacts in 2026. As things settle, value chains may move and regional trade networks could become deeper, creating opportunities for countries that can invest appropriately. And overall, there is now an increased impetus for countries to build economies that are diversified along many different dimensions. So such an outcome over the medium to longer term will strengthen resilience for everybody and also open up new possibilities. I will now hand over to Ingo from my team to present a more detailed look at our report. Thank you for your attention.
Thank you, Shantanu, and good afternoon, ladies and gentlemen. Let me share some additional insights into how we see the global economic outlook shaping up. But first, I want to emphasize that our forecasts come with a significant degree of uncertainty given the rapidly shifting global policy landscape, which poses major challenges for economic projections. Our overall message is sobering. Economic growth is slowing, uncertainty is high, and risks to development are mounting. The higher US tariffs and the policy unpredictability are weighing on the global economy. And this is compounding structural challenges, which we had highlighted previously, like high debt levels, weak investment, and subdued productivity growth. The lack of clarity around trade policies and their impacts is making it harder for firms worldwide to plan and invest confidently, while also complicating monetary policy making. In our baseline scenario, we therefore project global growth slowing to 2.4% in 2025, down from 2.9% in 2024, and that's a 0.4 percentage point downgrade from our January forecast. Both this year and next year, growth is expected to remain well below the pre-pandemic average of 3.2%. And this subdued economic outlook poses additional challenges for sustainable development progress, which is already lagging in many countries. Vulnerable and low-income countries are particularly affected, struggling to achieve the strong and inclusive growth needed to reduce poverty and improve livelihoods. The recent progress in easing trade tensions, including last weekend's temporary agreement between the US and China, is a step forward. However, as Shantanu mentioned, our estimates are that the US effective tariff rate remains high at about 14%, 6 times the level at the beginning of the year. And it's also unclear how all the bilateral negotiations will unfold. Overall, we have therefore project that global trade growth will slow sharply to 1.6% in 2025. That's about half of the rate recorded last year. We saw that US imports from China and also from other countries were front-loaded due to the tariff uncertainty. And while we expect more of this front-loading to occur now, given the temporary agreement, this effect is expected to fade over time. The chart here also shows that the persistent challenges in the euro area, the world's third largest economy, where both imports and exports remain weak. It's important to note that beyond the immediate impacts, the new developments could accelerate several structural shifts in global trade, including the rising importance of services, changes in the structure of supply chains, the adoption of advanced technologies, and also a gradual shift toward a more multipolar global economy. It is clear that we are entering a period of transition here, which will bring both challenges and opportunities for the world economy. The trade conflict is also having a notable impact on inflation dynamics. Our report includes a section exploring the challenges of managing inflation during periods of elevated economic uncertainty. In most countries, inflation has continued to decline, but the pace of easing has slowed. In our baseline scenario, global headline inflation is projected to ease from 4% in 2024 to 3.6% in 2025, which is 0.2 percentage points higher than our January forecast. As shown in the figure, average inflation rates in both developed and developing countries are still elevated compared to pre-pandemic levels. Food inflation especially remains a critical issue in developing regions such as Africa and Western Asia, and this is reflecting exchange rate volatility, ongoing conflicts, and climate-related shocks. Alarmingly, the number of countries experiencing annual food inflation above 20% has tripled from 6 to 18 between 2018 and 2024. When we look ahead, the falling prices of oil and other commodities we have recently seen are expected to reduce inflationary pressures. However, higher tariffs, especially in the US, could push consumer prices up, potentially resulting in higher inflation. Over the medium term, we expect that inflation risks persist due to supply chain disruptions arising from trade tensions or conflicts, and also the ongoing effects of climate change. Let's now turn to the regional picture. Compared to our WESP 2025 forecasts, we have revised growth projections downward for nearly all regions and country groups. These adjustments reflect both the direct and indirect effects of the ongoing trade tensions and country-specific challenges, such as worsening conflicts or policy tightening in some regions. We have moderately lowered growth rates by 0.3 percentage points for the major developed economies. In the US, growth is now projected to reach 1.6% in 2025, well below last year's 2.8% pace, as policy uncertainty and higher tariffs weigh on investment and consumption. In the European Union, growth is forecast to stay at 1%, with reduced net exports offsetting an uptick in consumer demand. Manufacturing-heavy economies with strong ties to the US face the greatest challenges. And while the Japanese economy has improved over the past year, we have downgraded the pace of recovery to 0.7% in 2025 due to weakening external demand and monetary tightening. Among developing economies, we are seeing a diverse picture, both in terms of overall growth prospects and the scale of downward revisions compared to January. In Africa, the outlook has been downgraded only slightly, but overall growth is expected to remain only modest. Uncertainties are large due to trade tensions, lower commodity prices, ongoing conflicts, and fiscal pressures. In East Asia, trade tensions are having a significant impact, particularly on economies with strong trade ties to the US. In China, the new stimulus measures and the temporary easing of US tariffs are expected to limit the slowdown, with growth now projected at 4.6% in 2025. In South Asia, support will come from resilient domestic demand and monetary easing, but policy uncertainty and fiscal challenges are weighing on growth. India remains one of the fastest growing large economies, driven by strong private consumption and public investment, even as growth projections have been lowered to 6.3% in 2025. In Latin America and the Caribbean, we see external and domestic headwinds, with diverging trends among the largest economies. While we project a significant slowdown in Brazil and hardly any growth in Mexico, Argentina is expected to rebound strongly as macroeconomic conditions improve. And in Western Asia, growth is forecast to slightly accelerate in 2025 compared to last year, supported by increased oil production. However, lower oil prices and policy tightening in Turkey will weigh on growth. Finally, in the least developed countries, the combination of trade tensions, policy uncertainty, and reduced development aid is creating additional challenges and macroeconomic headwinds. Average growth is projected at 4.1% in 2025, far below the pre-pandemic pace of 5.5% and well short of the 7% target under the Sustainable Development Goals. Turning to the policy front, the global shift towards monetary easing continued in early 2025, and this is likely to persist as central banks aim to support their economies amid weakening demand. In most countries, policy rates remain well above pre-pandemic levels, and that leaves room for further cuts. In many developing countries, lower inflation and more stable currencies have opened the door for monetary easing. Going forward, we foresee significant challenges, however, for central banks and policymakers around the world, particularly for the US Fed. Monetary policy decisions will need to be made in an environment of high economic and trade policy uncertainty, with the time lags between the actions and their impacts adding further complications. In the US, tariff-induced inflation pressures could complicate the Fed's ability to cut rates further. These challenges may result in global spillovers, affecting financial markets and constraining policy space for developing countries. On the fiscal side, we see increased risks for many developing countries as they may face lower export revenues, reduced foreign currency earnings, and potentially also tighter financial conditions. Fiscal space is severely constrained, with interest payments consuming an increasing share of government revenues. And this leaves many countries with very limited capacity to support growth and invest in development. Meanwhile, the shift towards unilateral trade policies threatens to further weaken the multilateral trading system, increasing the risk that small and vulnerable countries are marginalized. In such a challenging environment, we see an urgent need for a renewed global framework for financing development, a central focus of the upcoming 4th International Conference on Financing for Development in Sevilla next month. Thank you for your attention, and I want to encourage everyone to read the full World Economic Situation and Prospects mid-year 25 update, which is now online.
Thank you very much. We'll now take some questions. Yes.
Thank you very much on behalf of the United Nations Correspondents Association for doing this briefing. My name is Edith Lederer from the Associated Press. President Trump and his administration have said that two great aims of the tariffs are to first improve the U.S. trade imbalances, and secondly, he has said that an aim is to promote the return of manufacturing and other economic activity to the United States. I wonder if you could comment on that and if there is any sign that that's happening, or do you project this downturn and negative effect to basically ignore those two aims?
Are there more, or should we?
We'll take them one by one.
Okay. All right. Okay. I can start, and I think perhaps Ingo can come in. So, of course, the tariffs that were announced as reciprocal tariffs were designed to address bilateral trade deficits in goods. And past evidence as well as economic theory suggests that it's difficult to achieve this result if we are working only through tariffs. And in general, trade is quite resilient. It moves around, which is why I said that when the uncertainty is resolved, we can expect supply chains to move around. But there are also time lags associated. And it may be too soon to judge whether manufacturing has already started moving back into the US or other displacements have taken, especially since negotiations are ongoing and a lot of these tariffs are already under pause. So we would need to wait for a little bit of time to work out. But as I said, there generally is a need for complementary measures to support objectives such as increasing manufacturing, and these also have to take into account the fact that over time there has been huge technological changes in how manufacturing is done, as well as shifts in the comparative advantage of countries. So whether tariffs are the best way to induce these changes back still remains to be seen, unless there are complementary measures.
Do you want to add anything?
Just wanted to add that this focus on bilateral imbalances is somewhat problematic, because past experience has shown that while if bilateral imbalances get reduced, that might not really lead to a reduction in the overall balance. And here, I think it is a question of how much the US is consuming and saving. So these underlying drivers would need to be addressed.
Yes, Shidaji with China Central Television. 2 questions. First, you touched this a little bit, but how do you evaluate the joint statement from China and the US to the world economy this year? And secondly, do you agree that the only certainty now for economy is the uncertainty? Thank you.
I can start. Yeah. So we see that as a positive sign. This agreement reached last weekend, but this is just one step. And we also have to see that while the tariff rates have been significantly reduced, they still remain much higher than they were before. So we should also expect that this will have an impact on economic performance. And then, of course, there is a lot of uncertainty around where will this lead to? What will be the eventual outcome? Because there are significant policy differences. So this deal has not really resolved the problem of uncertainty. And this uncertainty is hampering growth everywhere. And I would therefore agree with your statement that that's the only thing we really know for sure.
So let me add a bit to that. I think one of the positive outcomes of this statement was a signal of the willingness to negotiate. And I think that's always important when you're talking about face-offs of this kind, whether it's in the trade field or whether it's anywhere else. And that in itself, I think, puts some kind of floor on how sort of adverse the impacts could be. So that is a very positive thing. On the other hand, as Ingo said, overall tariffs in the US with respect to China are still very high. Chinese side has tariffs too. And I think sometimes we forget that tariffs matter for a country's exports as well. Because they raise the price of the goods you're bringing in to make other stuff you want to sell to the rest of the world. And so their tariffs may be on imports, but they do have impact on how competitive your own exports are. And so basically it does mean that we understand the mechanisms quite well. And so when there's certainty about what's going on, we can be reasonably confident about our predictions. Thank you.
Yes, in front.
Thank you very much, Gabriel Zondo from Al Jazeera English. I just had a couple of questions on clarifications on some key numbers that you could maybe interpret for a non-economist audience. You said that the U.S. effective tariff rate is an average of 14%, 6 times higher than previous. Can you just explain what a U.S. effective tariff rate is? And then after that, you also said it remains trade policy uncertainty is a factor in itself. It remains elevated, having surged to its highest value in the last 10 years. What exactly, can you spell that out in a little more detail, what exactly that means? Thanks.
So the effective tariff rate is calculated by looking at the individual product group tariffs and then the amount of these tariffs by country, and then the amount of these products which is imported by the United States. So we are weighting this basically by the different tariffs. So this is a very quite a timely, this is a bottom-up approach, so basically going through all the tariff groups, what the US is having, and it's of course changing constantly. So it was at, I think, around 25 to 27% before last weekend the agreement with China was reached. Yeah. And I have to say that there are small technical issues involved here. So that's when you, for example, see that number. Other organizations or entities may come up with estimates slightly lower, slightly bigger, but the between 13 and 14% is what we're having at the moment. Yeah. And then on trade policy uncertainty, this is an indicator which is economic policy uncertainty is one of the indicators which have been monitored more systematically in the past, say about 10 years. And there is a category also in there of trade policy uncertainty. So this index is available. I think there's also a you will see that in the full report, and then you can go to the website. It is a tool that's largely based on. It is very difficult to. You cannot measure uncertainty directly, so it is measured mostly through looking at media. Basically, how often does uncertainty factor in media outlets?
So I should just add that the effective tariff rate is our computation. Others also compute them. But the trade policy and economic policy uncertainty index, this we are reporting not through our own computation, but through an entity which you will see referenced in our report.
Thank you. Stefano Vaccara, La Voce New York and the Ital Press. You say slower growth threatens the SDGs, but isn't it also true that slower economic activity and reduced trade, like we saw during the pandemic, has reduced emissions and environmental pressures? So shouldn't this also question the contradiction between climate goals and the obsessions with growth?
Sure, take that. You're right. I think when fossil fuel-driven activity slows, you do see, and if it's on a large enough scale, you do see a change in emissions. Now, what we are seeing here is not negative growth, as happened during the pandemic. We are seeing slower growth. So, and we're also seeing this in a context where a good deal in many economies, where a good deal of economic activity is now powered through renewables rather than fossil fuels. So taken together, this earlier relationship is not as robust as it might have been. And I think we also have to take into account that when we are talking about lifting people out of poverty per se, that's an extreme poverty line of a little over $2 a day. The economic activity of these households is generally not really very emission intensive. And so in that sense, I think we have to be, we are aware that there is a difference, but the aim of something like the 2030 agenda is to try and make sure that we are advancing on all of these simultaneously.
Just one additional aspect is that there's still a very large number of people living in poverty, and it is very challenging to lift people out of poverty purely through redistribution. So some economic growth and larger cake basically is needed. And I think the challenge is not, or the solution cannot be to say we will not need growth. I think we just need a different form of growth, which is on the one hand more inclusive, but also more sustainable from an environmental perspective. I don't see any way forward without GDP growing.
Just a quick follow-up. But if we're talking about slowing, you know, here's for your report, at least for what I understand, here's that there is we're slowing. There is growth. It's just slower. Shouldn't be this actually the goal? Having a slower, always growth, but slower, so we can implement that transformation that you're talking about environmental policy. And finally, when all these are completed, then you can, if you want, you can go up again. But if this report saying basically that we are in trouble because we don't have a strong growing, then it's in contradiction with at least goal 13, I think is in contradiction.
Actually, what we report are growth rates, and so rates really depend on how big the denominator is. It's how much you're changing divided by where you're at. So for an economy that's valued in the trillions, that denominator is very large. So even a big growth rate or increase in economic activity can show up as a small rate. So that's why many developed economies tend to show up in our reports as growing at slower rates. But for many developing countries, and especially the poorer ones, the size of the economic activity is itself quite small. So in order to catch up, or in order to create the opportunities, I mean, growth in itself is not terribly helpful. It's more in terms of the opportunities it creates, right? So in order to create these opportunities when the economy itself is small, one does need to grow these economies at a slightly higher rate than the ones that are already large. So applying the same growth rate across the world, I think, wouldn't really help here. Thank you.
Yes, one more question.
Thank you. Evelyn Leopold, excuse me, Dag Hammarskjöld Fund for Journalists. I wondered if the low-income countries have had an effect of the soft power being canceled. The U.S. the Trump administration has canceled U.S. aid, which certainly was aimed at developing nations. Did you find any impact from that? And secondly, before you sign off, I'd like the full address we could read your report online.
So on the impact of US policies on the least developed or vulnerable countries. This is too recent to be factored into our forecasts right now, because we would first need to see how this is unfolding and how this is really impacting. I mean, we have seen anecdotal evidence of very severe humanitarian consequences. But from a macroeconomic perspective, we still need to wait to see how this will unfold. So I had emphasized all these different measures which are happening. They take some time first to be implemented, and then for the economic activities to be affected, and then to be measured and to be reflected in any data on which we rely. So we will very closely monitor that, what is happening here, especially in vulnerable and least developed countries. But we have also downgraded our forecast, so there is some effect, but it's not yet fully reflected.
What is the
Microphone.
The website for the report. Oh, you wanted to know where you could read
yes,
the
there will.
report,
What is the
right?
address
So
of that?
this is
We
on the
will
slide.
circulate,
Is it?
I think
So
it's
on
in
the
It is under DESA
Publications.
publications here, so it's on
So
the.
it's
Yeah.
desapublications.un.org.
We can recirculate it too. Yeah, so the report is online, and I think this concludes our briefing. There's no more questions. Thank you very much. Thanks for joining. Thank you.